Imagine this for a second. Two people walk into a bank on the same day. One leaves with debt and spends the next 10 years trying to escape it. The other leaves with debt and quietly builds wealth that changes his family's future. Same bank, same system, same money. Totally different outcome. Most people are taught that debt is dangerous, that it is something you avoid at all costs. That owing money means you are behind in life. And for most people, that belief is not completely wrong. Bad debt is everywhere. Credit card balances for things that lose value. Car loans for cars that depreciate the moment you drive away. Personal loans for vacations and lifestyle. Upgrades that disappear long before the bill does. But here is what nobody explains clearly. Debt itself is not the problem. Ignorant use of debt is the problem. Rich people understand something the average person never learns. Debt can either trap you or it can accelerate you. It depends on what you attach it to. When wealthy people borrow money, they usually do it with a purpose that creates more money than the cost of the loan. They do not borrow to consume. They borrow to acquire assets. They borrow to control something that produces income. They borrow to buy time, scale, and opportunity. Think about real estate for a moment. A regular person might save for years to buy a small property in cash. It feels safe. It feels responsible. But it takes forever. A wealthy investor looks at the same property and thinks differently. He uses a mortgage. He puts down a portion of the price and lets the bank finance the rest. The tenant's rent covers the mortgage payment. Over time, the loan gets paid down. The property appreciates. And the investor builds equity using mostly other people's money. That is leverage. And leverage is one of the biggest wealth-building tools in the world. It allows you to control a large asset with a smaller amount of your own cash. If the asset grows in value or produces steady income, your return on your original money multiplies. The key difference is that the asset pays for the debt, not your salary. Rich people are obsessed with cash flow. They ask a simple question before taking on debt. Will this loan put money into my pocket every month after expenses? Or will it take money out? If it takes money out, it is usually a liability. If it puts money in, it can be an asset. That mindset alone separates consumers from investors. Another way wealthy individuals use debt is in business. Instead of waiting years to save enough money to expand, they use financing to grow faster. They might borrow to open a second location, to increase inventory, to invest in marketing, or to hire key employees who can multiply revenue. The borrowed money is not for comfort. It is fuel for growth. If the return on that growth is higher than the interest rate on the loan, the difference becomes profit. This is why you often see successful entrepreneurs comfortable with large lines of credit. It is not because they love owing money. It is because they understand how to deploy capital efficiently. They see money as a tool, not as something emotional. They calculate risk. They study margins. They plan cash flow. Then they act. There is also a psychological layer to this that most people ignore. Average earners feel stress when they hear the word debt, because their debt is usually tied to lifestyle. Monthly payments feel like pressure, because they are funded by a paycheck that could disappear. Wealthy individuals reduce that stress by attaching debt to income-producing systems. The system carries the weight, not their personal time. Consider how corporations operate. Massive companies borrow billions of dollars. They issue bonds. They take loans. They use credit facilities. Yet nobody calls them irresponsible just because they have debt. The reason is simple. Their debt is structured around revenue-generating operations. It is strategic. It is calculated. It is part of the growth engine. Rich people also understand the power of inflation in relation to debt. When you borrow money at a fixed interest rate, you're paying it back with future dollars. If inflation rises and your asset increases in value, the real cost of your debt shrinks over time. In simple terms, you repay yesterday's loan with tomorrow's cheaper money, while holding an asset that may be increasing in price. That dynamic quietly benefits those who own appreciating assets. Tax strategy is another factor. In many cases, interest paid on business loans or investment properties can be tax deductible. That reduces the effective cost of borrowing. Meanwhile, the asset continues to generate income and appreciation. The wealthy rarely ignore tax implications. They structure deals with professionals. They think long-term. They look at the net result after taxes, not just the surface numbers. Now let's be clear about something important. This does not mean debt is magic. It amplifies whatever it touches. If you attach debt to a bad investment, it will multiply your mistake. If you overestimate income or underestimate expenses, the leverage can work against you. That is why education and due diligence matter. Rich people do not gamble blindly. They study markets. They analyze numbers. They build reserves. They plan for worst-case scenarios. They also diversify risk. They do not put everything into one single leverage bet. They spread investments across properties, businesses, or asset classes. They maintain liquidity. They keep emergency funds. The outside world often sees the bold move, but not the quiet preparation behind it. Another smart use of debt is buying assets that generate compound growth. For example, acquiring shares in a growing company, purchasing rental properties in strong markets, or investing in a business with scalable revenue. If the return on investment significantly exceeds the interest costs, the gap creates wealth over time. The larger and more consistent that gap becomes, the faster net worth grows. There is a concept called opportunity cost that wealthy individuals take seriously. If they can borrow at a relatively low rate and deploy their own capital into something that earns a higher return, they will often choose to keep their cash invested and use debt strategically. Holding onto liquidity while controlling assets gives them flexibility. Flexibility creates options. Options create power. Meanwhile, the average person is often focused on eliminating all debt before investing. While paying off high-interest consumer debt is absolutely wise, refusing all leverage can slow down asset accumulation. Time matters in wealth building. The earlier you control appreciating assets, the more you benefit from compounding. Real estate is a clear example because it is accessible and tangible. A property purchased with reasonable leverage can appreciate over decades while tenants cover most of the cost. Over time, rent increases, the loan balance decreases, and equity expands. That equity can later be used as collateral for additional investments. One asset leads to another. Growth becomes exponential instead of linear. Business acquisitions work in a similar way. Some investors buy existing profitable businesses using financing. The business itself generates cash flow that services the debt. After the loan is repaid, the owner retains a cash-flowing asset. The original borrowed money becomes a bridge to ownership. Notice the pattern. Debt is used to acquire or control something productive. It is rarely used for consumption. Rich people separate wants from investments with discipline. They might enjoy luxury, but usually after assets are in place and cash flow is stable. There is also a mindset shift involved. Many people see debt as a burden because they see themselves as the one who must work to repay it. Wealthy individuals aim to structure deals so that the asset works to repay it. That small shift in thinking changes everything. Instead of trading more hours for payments, they design systems that generate revenue automatically or semi-automatically. They are also patient. They do not expect instant success from leveraged investments. They think in decades, not months. Short-term market fluctuations do not scare them out of well-researched positions. They understand cycles. They prepare for downturns. They keep reserves to survive rough periods without being forced to sell at the worst possible time. Risk management is always part of the equation. Insurance coverage, conservative projections, fixed-rate loans instead of variable ones in uncertain markets, and stress testing numbers before signing contracts are common practices. Smart leverage is disciplined leverage. It is never reckless. Another subtle difference is financial literacy. Wealthy individuals often surround themselves with accountants, advisors, and attorneys who help structure deals efficiently. They ask questions. They run scenarios. They do not rely on hope. They rely on data. At the same time, they accept that some level of risk is unavoidable. Complete safety often means stagnation. Strategic risk, supported by research and reserves, is what allows growth. They are comfortable being temporarily uncomfortable because they are building something long-term. If you step back, the pattern becomes clear. Poor use of debt finances a lifestyle. Smart use of debt finances assets. Poor use of debt increases monthly stress. Smart use of debt increases net worth. Poor use of debt depends on your time. Smart use of debt depends on systems and cash flow. None of this means you should rush out and borrow money tomorrow without preparation. The foundation always comes first. Stable income, emergency savings, basic financial literacy, understanding interest rates, understanding cash flow, studying markets before entering them, building gradually rather than jumping blindly. Start by changing how you think about money. See it as a tool. See banks as potential partners rather than enemies. Understand contracts before signing them. Learn the difference between good debt and bad debt. Ask whether a loan will produce income or simply produce bills. Over time, as knowledge grows, opportunities become clearer. You begin to see that the wealthy are not playing a different game. They are playing the same game with different rules and different strategies. They are not afraid of debt. They are afraid of wasted opportunity. They focus on ownership. They focus on leverage. They focus on assets that can grow even when they are not actively working. In the end, debt is neither hero nor villain. It is an amplifier. In the hands of a consumer mindset, it creates chains. In the hands of an investor mindset, it can build freedom. The difference is not in the money. It is in the thinking behind it. If you learn to attach borrowed money to productive assets, manage risk carefully, think long-term, and prioritize cash flow over lifestyle, you begin to use the financial system the way the wealthy do. And once that shift happens, debt stops being something you fear and starts becoming something you understand.